And our top story today, markets rising slightly to kick off a busy week. Investors are eyeing both Wednesday's Federal Reserve decision on interest rates and Friday's updated read on the job market. Let's get the read from former OMB chief economist Vance Ginn and Bullseye option chief market strategist Alan Nookman. Great to see Alan again. It's been too long. Vance, I want to go to you first because while as important as the Fed decision always is, particularly to investors, a lot of the interest rate increases are coming from the Treasury busily trying to sell debt in order to pay for its deficit spending. Isn't that something we should keep an eye on at least as importantly as we do on the Fed?
Well, it's a pleasure to be with you, and you're exactly right. They're spending way too much in Congress out of D.C., and that's increasing the supply of bonds, and pushing the prices down and interest rates up. And we're seeing interest rates continue to soar. 10-year rate around 4.3%. Where are people moving to? They're moving to gold. Gold continues to go up. And so what we're seeing is this quite slower economy, higher inflation, stagflationary period, and we're going to continue to see a lot of debt being put out in the marketplace. So higher interest rates are going to be the result, and likely lower stock prices going in the future.
Another result of all this, Alan, is the amazing increase in debt payments, huge debt payments as a result of having to sell bonds at a higher interest rate. That means you spend more. We are now spending more on payments for our debt than we are on all of the defense spending. Defense spending was $822 billion. It's more on our debt spending, on fulfilling our agreement to pay off those interest rates. So something's got to be done here. Are investors concerned about this at all?
Well, the market's telling us no. I mean, we're 2% away from the all-time forever top. We bounced 47% off the 2022 low. It's been a buy-the-dip market for a year and a half straight. So eventually, those kind of fundamental facts can have an impact on the market. But looking at where we are, we're here for longer. We're not higher for longer. We're here for longer, but it looks like we're going to cut rates. We've got a 30% chance in July, or a 60% in September, or an 80% in December. So rate cuts are coming.
I just want to stick with you for a second, Alan. How much of market enthusiasm right now has to do with AI? We saw those great stats coming in from Microsoft and Google last week.
Right.
Is AI the key? Do people think, investors think we're right on the verge of the kind of technological revolution we saw in the 80s?
It's very possible, but you have these cycles where the hot sector runs the market for a while, and then oftentimes they peter out. But if you look at the big boys, if you look at Google and Microsoft, how much money they're making in pure profits, we're talking $20 billion per quarter. Corporations are still doing extremely well. To get back to the rates, I'm an old grizzled trader. All right, I'm going to throw something out here. For 225 years, since the Washington administration, the average rate has been right here, right where we are right now, about 4.5%. So we're at the average rate. We got spoiled with free money, and now we're about at the average. It hasn't impacted the market yet. We are in an everything bull market until proven otherwise. And last week is a great example of the resiliency of the stock markets and the opportunities that we have in stocks on the upside.
Well, back to Vance, because while it's great for Wall Street, it's not great for Main Street. Americans feel the pressure of these higher interest rates like they haven't in years before, Vance. And we can't buy houses that we want to with mortgage rates over 7%. We can't buy cars with the loans. We're getting screwed in terms of how Americans feel. That's why they feel the economy's not doing well for them. What is going to change that, Vance?
You're right. I mean, we have this housing affordability crisis that's going on across the country with higher interest rates, higher home prices. Some of them are starting to come down a little bit now, but as the other guest is saying, I don't think we're going to see lower interest rates for a while. Some were expecting early in the summer, a few months ago. Now it's looking at later in the second half of this year. I think that will be the case, but that won't help the housing market for a while. And at the same time, many people are saying, you know what, I don't want to leave my house. So they have this lock-in effect, which is going to keep supply off the market, keeping housing prices higher than otherwise. So it's something to look at.
Vance, the other thing I wonder about what's happening with the debt. We have the debt, by the way, closing in on $35 trillion. Never been this high. It's even higher than it was at points during World War II. But the dollar has come on pretty strong. There's the debt clock. The dollar's doing pretty well right now. It's stronger than other currencies. Why is that?
Well, I think you got to say, where do you want your money to be? And a lot of them would rather be in the United States and America in the dollar compared to other currencies. This is a global competition with these exchange rates, and that's where it's telling us, plus that we have the higher interest rates, whereas some of the other countries are starting to say, look, we're going to start lowering interest rates earlier, and that's where the money starts to flow is to the dollar. So it's something else to look at, moving into the future.
And Alan, finally, are you worried that the higher interest rates, in the past, higher interest rates had meant trouble for NASDAQ, for all the tech stocks? That doesn't seem to be happening now, partly because of what's happening with the profits coming in on AI. Is that going to continue? Are tech stocks no longer concerned about rising interest rates?
I think we have to focus on the word higher. We are higher than zero. Yes, we're at the average we've been in 225 years. We got completely spoiled. Back to housing affordability, the major asset for every American is their home. 60% of Americans own a home.
Yes.
The average home equity now is $200,000. They've made a lot of money. That's why they don't want to sell.
Yeah.
They've made a lot of money.
The problem is young people can't get into this market. Young people are squeezed out. They can't afford the higher interest rates or the higher costs of the houses.
I had to start small.
Well, the bottom line is it's a lot tougher now than it was just a few years ago. Gentlemen, that was a great discussion. Thank you very much to both of you.
Thank you.
To the anti-Israel protests now that are rocking the